Hey everyone, welcome to Make Money Count. Today we're going to talk about your mortgage renewing. We got a little bit of a problem, I would say. Some people have a problem with their mortgage renewing. They
I'm excited about today because Justin printed out notes.
Yeah,
Justin made notes for today, and I do think it's going to be a good topic.
yeah.
Justin picked the topic for today,
Yeah.
how to optimize your mortgage renewal.
Mhm.
I think it's a great topic.
Mhm.
I think it's going to be a great discussion. There's a lot of things to look out for.
Mhm.
Interest rates have gone up.
For sure.
And as
For
a result,
some.
no, I think interest rates went up for everybody.
Yeah, in generally from 5 years ago.
Yeah.
Yeah. But listen, like their stats say that 60% of Canadians are going to be renewing their mortgage this year. The thing that you have to think about here is like not all of these people had 5-year fixed either, right? So like people who took a 3-year mortgage 3 years ago,
Some people are getting a better rate.
yeah,
right
some
now.
people are going to be getting a better rate for sure. Like your boy, Justin. Yeah.
Oh, because you still didn't do anything with yours.
No,
right?
I'm still just sitting here waiting.
Just
Yeah.
getting reamed in a 5.5.
Yeah, 5.65%.
Nice.
Yeah.
Didn't want to pay that penalty. Eh?
No, and I was too scared to take a variable, which I should have done. That would have been the move, right?
I mean, you hear me saying it.
Yeah. Pretty much every 5-year term you clip out of history, except for one which we won't talk about, it was good to take a 5-year term. You know,
What?
good to take a variable. I meant to say.
Yeah.
Yeah.
Take a variable rate.
Yeah. Take
The
a
variable is always the winner, like
Yeah.
historically, except for that one little period.
Yeah, that we won't. Well, we're going to talk about it today.
So listen, you run the show today, but let's get into it.
Right. Listen.
Great notes, by the way.
Yeah, you like these notes?
Great notes.
Yeah,
You didn't
AI
make these.
definitely didn't make these for me.
Oh, really?
Yeah, no,
You
they
made
didn't.
these notes?
No, AI made them.
Uh,
Um, listen, the point being here is like if you took a mortgage 5 years ago and you took a 5-year term, which if you were smart, you did, you would have taken some like I was just spoke to a client yesterday who took a 1.39% 5-year fixed. It's crazy. And these people are going to be coming up for renewal and they're going to be impacted. And there's a lot of them. There's people like every day.
someone had a 139.
1.39, yeah. I spoke to them yesterday. Yeah, and they're
That was when we were talking about the possibility of negative government of Canada bond yields.
right. Yeah,
Like certain countries had slipped into negative yields.
right.
Like, do you remember that? We were
Yeah,
talking
I
about-
can't even fathom what that would mean for Canada, but
Yeah, like there was a period of time where, like, was it Denmark? They were paying people who had mortgages
that's crazy.
because the way the product was structured off of
Yeah.
interest rates meant that they had a negative interest rate.
Yeah.
So the debt that they had on their mortgage was a savings account because there was such a flight to safety that government bonds, people were paying to keep their money in a government bond.
that's crazy.
Yeah.
That's crazy. Well, we're definitely far from that now.
It's like when oil went to zero.
right. And people paid you to like what do you mean?
No, the price of oil was effectively zero.
Right.
And as a result, certain people, I remember reading, they did a study. Somebody analyzed that you could have bought a used tanker for $25 million, filled it up with oil, parked the tanker like out in the ocean for a period of time, and then brought the tanker in, sold the oil, paid for the tanker that you had just bought, and made a profit.
That's crazy.
Yeah, contango, I think the trade is called, when you like buy oil when the market is down, hold the oil, and then resell the oil, physical oil, back into the market when the price goes back up.
Interesting.
You need to have a tanker to do it.
Yeah, you need a lot of space.
But in the case of the Dutch with their mortgages, they just need to have a mortgage.
Right. Interesting. Well, listen, if you got a mortgage and it's coming up for renewal and your rate was 1.39%, what is that going to look like for you? So I did a couple numbers that we can talk about, and then we can talk about like best ways to optimize, which we've talked about a million times. If you watch the show, you've heard us talk about it before. But I did some numbers. So if you took a $1 million mortgage 5 years ago at 1.49%,
You said 1.39.
No, I said 1.49 in this particular
Oh,
instance.
that's not confusing.
1.49%. You took $1 million
This
mortgage.
scenario is not in the notes that I received.
Well,
But
that's
okay.
interesting. They're in my notes.
Okay.
$1 million 5 years ago. Your payment would be $3,444. It's dirt cheap for $1 million mortgage. Your balance at maturity right now, if your mortgage was coming up for renewal, would be $862,000.
So
Give
in
or
that
take a
5
few
year
bucks.
period, I paid off 140 grand.
Yeah, it's a lot.
On a 30-year AM?
30-year AM. Yeah. And if you renewed your mortgage straight up, you'd be looking at about $4,500 as a mortgage payment, $4,533.
So maintaining the amortization. So
Maintaining the amortization.
I'm going to a 25-year AM.
25-year. Yeah, exactly. So basically, your payment's going to go up by $1,000, which thank goodness this individual that we're talking about here didn't come up for renewal in, a couple of years ago, because they would have been in trouble. But so your mortgage rate, your new mortgage payment would be $4,533. The couple of the ideas that we were talking about were like re-amortizing your mortgage, right? Which would bring this individual's mortgage down to $4,097. So saving them about $500 a month.
But still up $600 a month.
Yeah, exactly. I mean, I don't think there's a way to really get out of it unless you started 5 years ago with a 25-year amortization, which would be interesting to look at going back up to 30. I'm sure you could even out your payments at that
That's
point.
not in the notes.
It's not in the notes. It's not in the notes. So how do you best prepare for your mortgage renewal? How do you best prepare?
Well, it's in your notes.
Yeah. I would say, generally speaking, our salespeople at Cannect will get in touch with you about 5 to 6 months before your renewal date. I mean, a year before that, we're having a conversation with you to see, what your plans are, what you're thinking of doing when your mortgage comes up for renewal. Obviously, in this situation, it's like salvaging your monthly nut, basically, is going to be your can I say that here? Okay. Salvaging your monthly nut is going to be the main topic of conversation, right? Like, isn't that a term?
Yes.
Your monthly nut, yeah. And we want to get
Low
started
nut.
as soon.
You wanna
Yeah,
keep
you
the
want
low
to
nut.
keep your nuts low. But in reality, getting started on a mortgage, we'd probably be looking at about 4 months before your renewal date to be submitting your application.
Yeah, because there's some lenders that'll give you a 120-day rate hold.
Yeah, exactly. And then the big question is, like, what rate do you take? I mean, for the last while, we've been talking about variable rate. We normally talk about variable rate.
So
But what do you think?
listen, all day long, if you're 120 days out, especially in this market, you take a fixed rate. Like
Okay.
right off the bat, send the client in for locking in a fixed rate.
Okay.
The bond yields, 5-year Canada bond yield has been oscillating between 2.6 and 2.9%. 5-year fixed rates are at 3.8, 3.9 right now because the yield is at like 2.65 as of today, off the back of a CPI print that was like marginally lower than expected. So there are some factors that are keeping bond yields low, which is kind of like the prospect that the Bank of Canada may decrease rates.
Right.
Consensus is that they're not going to drop rates. Overnight rates 2.25. The possibility, the probability that the Bank of Canada may drop rates. So even if it goes from like is a 0% chance that they're going to drop the overnight rate to a 15% chance they're going to drop the overnight rate, bond yields will drop on the back of that, right? On the back of the information that's being fed into the brain of the bond market.
Right.
All of that is to say that if you are looking right now for an interest rate, you lock in 120 days out. Man, if there was a lender that could give us a 150-day rate hold, we would push in at 150 days to lock in the best 5-year fixed rate we can for somebody.
Right.
And then as you get closer to the time that your mortgage is actually, you got to pull the trigger, that's when you start evaluating. If between the date that you lock in the first fixed rate for the client and the closing date, if fixed rates drop further, if bond yields drop further, then you're locking in again. So it's kind of like our job at Cannect is to constantly evaluate interest rates for everyone that's in the queue to get a mortgage. So at any given time, we have 1,000 people that we're looking to secure the best mortgage rate for, all of whom are locked into some rate that is between 120 and 30 days before they're closing, all of whom we are scanning the market for to try to find the best rate possible on the fixed side before their closing date. And then, close to the closing date, you have a conversation with the client and you do an analysis as to whether or not they want that lowest 5-year fixed rate or a variable rate.
Right.
I believe today that the probability of interest rates going lower in Canada, 25 basis points, coupled with the discount that you get comparing the variable rate and the fixed rate, it makes me lean more towards the variable rate today.
Right.
So like best 5-year fixed rates,
Noon on February 20th.
Yeah,
It's
best
variable rate.
5-year fixed. I'll stand by it for the next week. Best 5-year fixed rate right now is 374, and best variable rate is 335.
Yep.
So you're gonna get 40 basis points off, and I believe that with the variable rate, you're more likely than the market anticipates to see another 25 basis points. And I say that for two reasons. I say that reason number one, the Canadian economy is weak. And although the government of Canada is pumping more money into the economy than we had probably initially expected a liberal government, even a liberal government, to do, they're pushing a lot of money into the economy. However, the Bank of Canada sees weakness, and we have a housing market that is like eating itself. Like it is. CIBC issued a report, and they had a really good quote. They said, like, the best way to describe the current state of the housing market is to say prices are still too high to buy and not high enough to build. Like, there's a real problem in the housing market, specifically for condos, but that's weighing the whole market down. And as a result, employment's going to be impacted. Consumer confidence going to be continued to be impacted. Consumer spending is going to be impacted. We saw an inflation print that came in a little bit lower than expected. It's still being distorted by the GST break that Trudeau gave for the restaurants and snacks. Like,
when you didn't have to pay tax?
yeah,
That was amazing.
well, but as a result, now that you do have to pay tax,
Of
inflation
course.
is
Yeah,
higher.
it looks higher, yeah.
Right? So I would say that. So that the fact that I think inflation is going to come off more, I think that the economy is going to show more signs of weakness. Like in your notes, you cited that like CREA or TREB is predicting that housing prices are going to go up. Don't think so, pal. Anyways,
I mean, eventually.
so that coupled with the United States has an incoming chairman of the Federal Reserve who has a bias towards lower interest rates. If the United States starts dropping interest rates, their dollar will weaken, which means it will give Canada room to drop interest rates without weakening our dollar.
Right.
Right? So those are the two main reasons, I would say. I mean, it's got kind of three reasons, right? Inflation is starting to appear to be more controlled. Even the core trim numbers, which are a little higher, they're like 2.5, 2.4. That's the number that the Bank of Canada prefers because it strips out the super hot inflation numbers or the super low inflation numbers. It kind of gets the core basket. Even that number is starting to fall like closer in line, even though it's a little hotter. But it's the weakness. It's the problems that are still kind of not accounted for really in the economy that are going to get a little bit worse.
Right.
So if the economy still keeps going sideways and maybe sideways to down a little bit more, it'll give the Bank of Canada a need to do something. In addition, the United States is going to drop rates.
Right.
We got a 2.25 overnight rate. Could that overnight rate go down to 2? Yes. Is it going to go down to 175? Probably not, unless we're in real trouble. But the United States is going to drop rates. So even though no economist at any bank in Canada right now is saying rates are going to go lower, I think that before the end of the year, we may see another 25 basis points off the overnight rate.
I mean, the economist that Connect is the only economist that really matters. So,
anyways, thanks. But so I would say I think we could see another 25 basis points, which means your 40 basis points discount that you get right now between the fixed and the variable could turn to, 65, 70 basis point difference. Again, if the overnight rate drops again, then we might see the discount off prime on the variable rate shrink because the economy gets in rougher shape and the banks look to profit take a little bit on that product. They call it like accounting for risk, but really they're just increasing net interest margins.
gobbling it up.
Yeah. However, again, mortgages are kind of like something that people have to evaluate for risk for themselves based on their own risk propensity. So some people might say, you know what, I don't care about the 50, 60, 70 basis points. I'm cool.
Yeah. I mean, I just had a conversation with a client this morning that was saying, like, that was kind of the thing, right? It's like for 40 basis points, the mortgage wasn't huge. Over the next 5 years for a few grand for the comfort. You know what I mean?
Yeah. I was giving this example to somebody the other day. $1 million mortgage, 1% discount, $10,000. The people that have that $1 million mortgage probably make $200,000 a year. $200,000 a year after tax is $100,000 a year. $10,000 is 10% of their after-tax income that they could save.
Right.
How hard would you work for a $20,000 bonus?
Right. I mean, it's a lot of money.
Yeah. And the other thing is fixed rates, you have to break them.
Yeah.
And like we're seeing that happen right now. Like Super Broker over here didn't even want to break his own 5-year fixed rate.
It was too expensive.
Yeah. Well,
yeah.
But if you look at the numbers, you probably would have saved money even if you broke the mortgage.
Yeah.
But you're scared to break the mortgage. So instead of paying the bank the penalty, you just pay your bank 2.5% of $1 million more than you should be paying them.
Which is exactly
Which is
the
now
math.
$25,000 a year in after-tax income.
Well, I get to
That
renew
doesn't
it.
happen with a variable rate mortgage.
Right.
In a variable rate mortgage, the only thing that happens is you got scared because you looked at bond yields and it looked like they were going up. So you locked into a fixed rate.
Right.
Doesn't cost you anything to do it.
Right.
And if you want to break your mortgage because something is going on, some life event occurs, which is more often than not what's going on, especially in today's market.
Yeah. What's the stat for how many Canadians break their
It's
mortgage?
like 75% of mortgages break before the end of the 5-year term. And more often than not, the banks are screwing people right now because those people are seeing a mortgage payment that they can't pay for, a house that's dropping in value, and they're getting worried about it. So they're breaking their mortgage because they're selling their house.
Right.
And then they find out that, oh, wow, in addition to the erosion of equity that I have seen and my inflated mortgage rate that I can't pay for, I just got levied a $30,000 penalty now. So, and that's a benefit that only comes with a fixed rate mortgage.
Benefit.
It's a joke.
Yeah.
Anyways, I didn't mean to derail your.
No, that's okay. I mean, listen, my mortgage.
So many interesting things.
I can
to say
renew.
about mortgage
I can
renewals.
renew my mortgage next month. So
Nobody cares, man.
I'm
You
very
already
excited.
missed the boat on it.
How do you know?
Yeah. You know, Scotiabank's saying is you're richer than you think.
Yeah.
You made them richer than they should have been.
Oh boy,
That wasn't that funny.
Well, I mean, it was funny for me. It was like painful funny.
Yeah, fair enough.
Well, listen, I think that's it for today.
You
I like your
my
mug.
Yeah.
I was just gonna say I like your mug.
It's the elephant mug from the safari Justin and I went on.
Yeah, it was quite the safari.
Tauhida got me a mug. She didn't get one for Justin, though.
My gift for Marcus was to haul literally a skid of clothing back to Canada with me. So that was my.
I like to
that
travel
was my
light.
Thank you gift. Yeah. All right. Thank you. Have a good day.
Thank you.